Imagine you wake up one morning, check your phone, and your investment portfolio is down 30%. 30% gone, just like that. Your first thought is, where did it go? Did someone take it? Is it sitting in someone else's account right now? Will it ever come back? These are the questions nobody actually answers properly. They just tell you to stay calm and think long term. But today, we're going to answer it completely honestly, because understanding exactly what happens to your money during a crash changes everything about how you invest. Welcome to Capital Secrets, where we reveal what the financial world never taught you. This is not financial advice. Before we talk about crashes, we need to understand one thing. What is a stock price actually based on? Here's the simplest way to think about it. Imagine you own a bakery. Your bakery makes $10,000 profit every year. Someone offers to buy it from you for $100,000. That price is based on their belief about what your bakery is worth and what it will earn in the future. Stock prices work exactly the same way. When you buy a share of Apple or Amazon, you're not just buying a piece of a company. You're buying into a belief about what that company is worth today and what it will be worth tomorrow. And here's the critical thing to understand. When millions of people change their belief about what something is worth, the price moves fast. That's the stock market, a giant real-time voting machine where every trade is a vote of confidence or fear. So when the market crashes, what actually changed? This is the question everyone asks, and almost nobody explains clearly. Here's the honest answer. Most of the money doesn't go anywhere. It disappears. Let me explain with an example. Imagine a house in your neighborhood sells for $500,000. Everyone in the street now believes their house is worth $500,000 too. That belief creates $500,000 of value in your mind, even though no money has actually changed hands. Now imagine the next house sells for $300,000. Suddenly, every house on the street is worth $300,000. That $200,000 in value? It didn't go to anyone, it simply vanished because the belief changed. The stock market works identically. When a stock drops from $100 to $60, that $40 difference didn't land in someone's bank account, it evaporated. It was paper value based on belief, and when belief collapsed, so did the number. This is why market crashes feel so devastating. Trillions of dollars of value can disappear in days, not because someone stole it, but because collective confidence collapsed. Here's where it gets really interesting. You're right, some people do make money during a crash, but it's a very specific group. Group 1. Short sellers. These are investors who essentially bet that a stock will go down. They borrow shares, sell them at the current high price, wait for the crash, then buy them back cheaper and pocket the difference. When everyone else is losing, short sellers are winning. This is how some hedge funds made billions during the 2008 financial crisis, while normal investors lost everything. Group 2. Cash holders. People who sold their investments before the crash and held cash. They didn't lose anything, and when prices hit rock bottom, they bought back in at massive discounts. Warren Buffett is famous for this. During crashes, he doesn't panic, he shops, because when everyone is fearful, assets go on sale. Group 3. Long-term investors who did nothing. Here's the most important group of all. People who held their investments through the crash and didn't sell eventually recovered everything and then grew beyond it. The S&P 500 has crashed many times: 1929, 1987, 2000, 2008, 2020. Every single time it recovered. Every single time it reached new highs. The people who lost permanently were those who panicked and sold at the bottom. Now you understand where the money goes. Let's talk about what actually triggers a crash. Because crashes don't happen randomly. Cause 1, fear and panic. Sometimes a piece of bad news, a war, a pandemic, a bank failure triggers mass panic. Everyone tries to sell at once, prices collapse under the weight of fear. This was 2020. COVID caused a 34% crash in 5 weeks. Cause 2, overvaluation. Sometimes stocks get priced way beyond what they're actually worth. Everyone believes the party will never end. Then reality hits and the correction is brutal. This was 2000. The dot-com bubble burst when tech companies with zero profits were valued at billions. Cause 3, economic shock. Sometimes the real economy breaks. Unemployment rises, banks stop lending, businesses collapse. The stock market reflects that real pain. This was 2008. A housing crisis triggered a global financial meltdown. Each crash looks different on the surface, but underneath, they all share the same engine. Belief collapsed, confidence disappeared, prices followed. Now, the most important question of all: what should you do when it happens? Step 1. Don't sell in panic. Selling during a crash locks in your losses permanently. The investor who holds through the storm eventually recovers. The investor who sells at the bottom never does. Step 2. Remember the history. Every single crash in history has eventually recovered. Every one. The market has never permanently gone to zero. When you feel like it's all over, look at the chart. Zoom out. The long-term trend is always up. Step 3. If you can, buy more. This sounds terrifying, but crashes are essentially sales on great companies. The same stock that cost $100 last month now costs $60. You're getting more for less. This is exactly what the wealthiest investors in the world do during crashes. They buy while everyone else panics. Step 4. Check your timeline. If you need the money in 1 to 2 years, a crash is genuinely dangerous for you. But if your timeline is 10, 20, 30 years, a crash is just a temporary dip on a very long journey upward.
So let's bring it all together. When the stock market crashes, most of the money doesn't go anywhere. It simply disappears because the collective belief about value collapsed. A small group of people, short sellers and cash holders, can profit from crashes, but they're the exception, not the rule. The vast majority of long-term investors who stayed calm, held their positions and didn't panic, recovered everything and grew beyond it. The real danger of a market crash isn't the crash itself, it's the fear it creates and the bad decisions that fear triggers. Because in investing, your behavior during the worst moments determines your results over a lifetime. Stay calm, stay invested, and remember, every crash in history has eventually become just a small dip on a much bigger chart. If this finally answered a question you've had for a long time, please hit the like button. It takes 1 second, and it helps Capital Secrets reach more people who need this information. Subscribe so you never miss a video. Every single week, we break down the financial concepts that most people spend years trying to understand. I'll see you in the next one. Let's go.